Good morning, good afternoon, and welcome to Quantifi and OTC Partners webinar on emerging trends in the global buy-side community. We are very happy and honored to have such an distinguished panel of speakers today to discuss the relevant issues in the global capital markets, OTC markets, and the regulatory impact that's affecting them both. We have Petal Walker, Chief Counsel of the CFTC, Avdud Naik, Head of Product for Quantifi Solutions, as well as John Kiff, Senior Financial Sector Expert at the IMF. I am Saul Steinberg, Founding Partner of OTC Partners, and with that, we'd like to start this lively conversation. The agenda for the day it is as follows. Let me just click this slide forward. Okay. Going to get used to the webinar platform, so please bear with me. Thank you. I appreciate the kindness. So the agenda of the day is regulatory reforms reshaping the financial markets, as well as key market drivers and their implications on the global financial community. We're also going to discuss modernizing business process and technology to ensure levels of operational excellence and efficiency, and new business strategies and models used to improve controls to increase and make more efficient transparency, returns, risk management, safety, and stability. So with that, we have many emerging trends that have set forth in today's OTC landscape and capital market landscape. As these things continue to change and we evolve from the US regimes of Dodd-Frank and we look to Europe with EMIR and MiFID, I'm going to turn it over to our panelists, John and Petal. What do you guys feel are the most meaningful regulatory reforms that are shaping today's markets? And please mention the evolution that we've experienced since the beginning of the financial crisis in 2008 with the implementation of Dodd-Frank, and as we continue to roll out regulation, what continues to be the most pressing issues and what are the most important regulations today and also of tomorrow? With that, I'll hand it over to Petal.
Hi, Saul. Before I say anything, my disclaimer, which is that my views are my own. They are not that of Commissioner Bowen, the Commission, or the staff. In response to the question, and I think it is important to understand that at the Commissioner's office, we are puzzling through a number of questions. So for a lot of these issues, we may have more questions than answers, but we think that the discussion is really where we're going to get the best answers, best viewpoint on what's happening in the market. In response to what's happening, or I'm sorry, what's the most meaningful regulatory reforms reshaping financial markets, I think there's three that come to mind. One is definitely mandatory clearing. I think requiring clearing of certain products and just having more of a focus on clearing has been a game changer. There are a lot more products that are currently being cleared. Even products that aren't required to be cleared are being cleared. You know, granted, there are other reasons for that besides mandatory clearing, but I think that the increased use of clearing has brought, writ large, a reduction in risk to our system because we are clearing on platforms that are repeat players. They understand the markets. And they're able to, have clearing at a reduced cost. I think similar to that, or kind of a piggyback on that, is trade execution. I think the rules on mandatory trade execution have been significant. Now, whether or not that has overall so far paid dividends or not, it definitely has changed the market, even if in a somewhat negative way, in which one of the main reasons why entities try to escape the Dodd-Frank regime is because of trade execution. It still indicates that this is definitely a change that has had major impact. And of course, the capital rules. There's no doubt that the capital rules have completely changed the way that banks think about their capital and how they use it, and it has had an impact on the industry. We will certainly discuss today the degree to which that has been overall negative or positive, particularly for our industry, but I think capital has definitely had an impact.
John, can I turn it over to you for to follow on that?
Sure, and I have the same general disclaimer, and it's really quite relevant in the case of the IMF because we have several people here very active in this space, and we often don't agree on various policy stances. But I'm going to be kind of selfish here and talk more about the trade reporting, which is very high on our priority list. In fact, if you go back to the Global Financial Stability Report, which we produce every 6 months back in 2010, we basically, the staff here, expressed the viewpoint that really trade reporting was the most important thing coming out of this reform process. And in fact, we weren't that keen on the idea of mandated clearing and trade-in. But getting back to trade reporting, you know, when we think back to when AIG was on the brink, the Fed at that time was able to gather together some information from DTCC on a voluntary basis to sort of map out the potential domino effects of an AIG failure. And so, I mean, that kind of highlights the importance of trade data. And so I think mandated trade reporting is an essential building block of the reform process. It helps regulators and financial stability authorities like us detect the buildup of dangerous risk exposures and these domino effects if a counterparty defaults. Unfortunately, there's a lot of issues with this particular mandate in that many jurisdictions have reporting restrictions on reporting, restrictions on their own counterparties reporting, restrictions on even some access in countries with multiple regulators. Only one regulator actually has access to this data, so there's a sharing problem even within countries. This all relates to, you know, sometimes how the regulatory framework is set up, and in some cases it pertains to privacy and secrecy laws, data protection regimes that block access. But you know, I'm talking here about inside the border sharing, but that it's even worse actually when you look at cross-border sharing of information, where and this is an international global market. So when you are looking again at a future AIG type situation, it would be very helpful to know about the interconnections and so on, you know, outside the home country, and that's where you need to tap into the cross-border information. That's rather clunky right now, and then there's another little wrinkle here too. This is where the selfish part comes in. Most the major countries block access by the IMF to this information, yet when we go to the Financial Stability Board, we're told that we're supposed to be the ones that are, or among the ones that are supposed to be looking out at the global interconnections in these markets. So we're told, yes, this is your responsibility, but no, you can't have the data. So we're kind of handcuffed. But the one solution to this problem is, and it's been looked at by the Financial Stability Board, is the idea of a central aggregator. Because another issue here is the multitude of trade repositories. There's about 24 of them so far, and there's differences in standards and data quality and so on. So there's talk about building a central repository for all this data that would then let folks like us access the data where the counterparties are anonymized, and so that end arounds the privacy law issues and so on, and allows us to help build these interconnected models. And in addition to that, there's also further work being done on data standardization and new types of legal entity identifiers, unique transaction identifiers. There's a whole slew of alphabet soup things to try to make this trade repository world work better. And needless to say, significant investment will be required, and we'll need also a lot of buy-in from not only the banks and the dealers, but the buy side too. And so, but I think that to me is the most essential part of this whole reform process.
Are we, if we talk about trade data specifically, and before we get to some of Patel's points of more of the execution and the capital hindrances to this type of trading. If we did have that global cooperation, do we have the capacity to understand all of these data points and to digest all these data points? And then, again, how are we going to get there for global participation? And what does that mean in the midterm? Does that mean more bifurcation of markets and more domestic kind of trading inside of markets and a reluctance for the buy side globally to do business internationally?
Well, I think we have people here who have built models on a smaller scale, and they're just waiting for the chance to get this data and put it to work. I mean, there's a whole academic literature on network analysis, and most of it uses either sort of fake data or in some cases maybe one jurisdiction data. There's one I think that was done for Europe where some academics worked with some guys at the ECB to build a network model. So, I mean, I think that the models and the technology is waiting there to be used, but we're a long way from actually having anything useful to pump into it. And one criticism is that, yeah, well, you're focused so much on OTC derivatives, but what about interbank deposits and so on? Well, yeah, I agree that we got to start somewhere, and we already have trade repositories in place for most OTC derivative types. So it's just a matter of improving the quality in the data and making it more uniform, so that given that we have 24 more trade repositories, we can actually sort of weave the data together to something useful.
No, it's certainly ripe with challenges, and there's a lot of stepping stones that we have to, overcome in order to get this transparent view. But if we take a step back and we mention some of the points that Petal mentioned before, as far as clearing and trade execution, what is the global importance to this? How critical is it that not only the U.S. or the European jurisdictions submit to a centrally cleared regime? How important is it from a global perspective in terms of safety and risk management? And then, and you mentioned execution. How are we going to really convert all these markets to purely electronic, which is the vision of the global G20, to make it a very transparent global electronic STP market? How are we going to get there?
Well, in terms of your first question and the importance of the global importance of the clearing mandate, etc., I think, I mean, certainly our goal is always, or one of our main goals, is to prevent regulatory arbitrage. And so to the degree in which we have uneven regulation, in which certain jurisdictions are highly regulated and have heavy rules and high walls to surmount, and other jurisdictions, are comparatively much more permissive, then we are going to have regulatory arbitrage. We are going to have areas globally that are just far more risky, and if those areas are significant enough, then that risk is going to travel, because especially in the derivatives markets, they aren't regional markets, they are global markets. And just as in like cybersecurity, if the weakest spot is going to really, or could potentially bring down the entire thing. So it's important that our regulatory regimes are just generally not the same necessarily, but consistent, and there aren't obvious places for regulatory arbitrage that could have disastrous effects. In terms of clearing, I think clearing, there are a number of issues with clearing that aren't necessarily just global, but and I think we'll get into those a bit later. But with clearing, we have to look at the individual products and see if they are ripe and ready for clearing. Clearing is an effective risk management tool when we are able to truly understand the product and to therefore come up with an IM number that actually makes sense, that's real, that really captures the tail end risk. If we have products that are more bespoke, are have much less liquid markets, and we aren't really able to come up with an IM number that's meaningful, DCO, despite its best efforts, simply doesn't have enough data to really predict that, and that product doesn't need to be cleared, and possibly clearing could be a dangerous thing to do. And so I think clearing carries with it some other considerations besides besides the global ones that I think are more pressing in some ways. In regard to electronic trading, the commission, I don't speak for the commission, but just looking back at the at what the commission has said, our rules, we don't favor one type of trading versus the other. If you look at in terms of the derivatives markets and CEFs, we allow voice brokering as well as electronic trading. And so, we haven't set a goal to move everything to electronic. That having been said, clearly, there are benefits to electronic trading, and I think that many market participants see those benefits in terms of the future of trading and allowing data transfer much faster, getting the prices faster, and then being able to get more things traded depending on the nature of the product. Once again, some products are so bespoke or just so complicated that they may not lend themselves to that. But for those that do, certainly that would help the market to invite or to be more inviting to other players when they can kind of see things on an electronic platform, real time, understand the prices, depth, have more depth of market. Therefore, so there are benefits to that. But just to be clear, we have not set it as a goal to move all trading to electronic. We understand our mandate and our statute, and there are many ways to trade.
How about the situation that's occurred in the last 12 to 24 months, where we see some larger sell-side banks kind of leave some of these markets and either close their FCM desks or kind of close certain product sets from their FCM desks? What is your feeling on this, and is this a bellwether for any kind of future trend, or is this more of a case-by-case situation that some of these banks have stepped out of the clearing foray?
Well, I definitely think, going back to my first response, that the capital rules have had an impact. We're still thinking about puzzling out whether or not the impact is an overall good one and overall in terms of our markets. I mean, definitely having more capital in the system, theoretically having banks really consider more the risk they're taking and have more collateral to support that in principle is a hard argument to argue against. But in terms of its effect on clearing, because clearing also has great benefits, as I mentioned before. And so when we have two good things, two good innovations, and yet they're at cross purposes, I think we have to look closely at why that's happening. And the pullback in the FCM space, the FCM concentration, certainly capital is a part of that. It isn't all of the story. There is an interest rate environment that's very distinct that's affecting that. There are other reasons in which FCMs, may or may not be able to survive or to keep the amount of customers that in the past they've had. But certainly the decisions on the use of capital, have been key to that. We're still trying to puzzle out to understand whether or not this is a change in the market that the market is able to absorb and to adapt to. Do we need more non-bank FCMs in this space? Is that overall possibly a healthy thing to have not as much dominance of the bank FCMs? And so the concentration of FCMs, could be a transitional stage, and maybe other players will step in to do that. We haven't seen, and talking about buy-side issues, one of the topic here, we have not seen many non-bank entities stepping into that space. And that's a question for us, in that maybe we need to reconsider what the clearing member, has been and what the clearing member will be in the future. Because banks have dominated that space, we've almost equated being a clearing member with being a bank, and banks have certain positives, lots of cash. They're extremely well regulated. They have several regulators. But as banks pull back, it may be time to start thinking about the future of the clearing member model and how do we attract more entities to that space who are not the typical entities. Recently, we saw that the CME lowered its minimum requirements in the IRS space for clearing members. That looks like an example of trying to bring more people to the, to the clearinghouse who have not in the past been there. And so, as regulators, then we have to think about, okay, now that the space is moving, is there a problem that we can meaningfully address? Two different questions. And then, what are our regulatory goals? When we have banks, we have a certain level of comfort because of the amount of capital, the excess capital they have, often, beyond our rules requirement. They have all this capital. So what are our, or rather, how do we adjust ourselves then to having possibly more non-bank entrants, and even making it maybe easier to have more non-bank entrants, but with the level of backing, the level of support, them being solid enough for us to feel comfortable. So those are some of the issues that we're looking at in terms of FCM concentration and thinking about in terms of clearing. I'll stop there in case I've more than answered your question.
No, that was excellent. So we spoke on the regulatory oversight of these new non-bank entities that might be involved as members of clearinghouses or involved more in the brokerage side of the equation. What does this do to market structure? Does this disintermediate sell-side banks in the future for other products? Does this have a negative impact on the global capital market structure at large, or is this a healthy thing?
That's the question that we're looking at. We've lived in a world, at least in our world, in terms of the CFTC and understanding, particularly with the swaps markets in which the banks have dominated for so long. It just seems like that's the way, that it's almost like because they've been around for so long and because they are the FCMs and that's the way it's always been. That's the way that works the best. But if the banks and as the banks are pulling back, and that may change. I mean, it's possible. Certainly, there are discussions right now on leverage ratio. Basel, right? They are looking at these issues, so it's possible there may be relief that may entice the banks back into that space if they want to come back. So it's possible there may be a reversal, but as the banks step back, then we have to consider the way forward. Now, one thing in terms of the question of whether or not it's a problem, in terms of for the immediate issue of porting, right? There very well could be a problem, this moment if there was a significant default, because as the FCMs, as the number of FCMs diminishes, the question is, do we have enough entities to take on all the positions if there is that major clearing member default or a couple of not so major clearing members default? Do we have the portability that we need at the CCPs? That's the question. And that's the question that we're definitely thinking about. Trying to figure out, okay, taking a real assessment of where things stand and not assuming that that portability is alive and well. And then if that's not the case, then going back to my earlier point, do we need more clearing members? Do we need more non-bank clearing members? They haven't, to my knowledge, been running to the space. Is it because of the capital requirements that we're imposing as a commission in terms of the capital that an FCM has to hold, and other safeguards or other requirements, for a solid, quote-unquote, solid FCM? And do we need to reconsider that? Do we need to encourage more self-clearing? pulling away from the FCM model because that's the, maybe that's the future. But if there is a porting issue in terms of just having enough entities to absorb the positions, then we have to think of ways in which that can be addressed, ways in which the industry can do it, but do they need support from us in order to do that? So, that's an issue that we're definitely thinking about.
If we do have,
by the way, keep in mind that this is a bigger issue than just the OTC space, right? It's I mean, everybody's talking about market liquidity and market liquidity fragility. We're doing it right here. We're doing some projects around that too. So it's kind of a overall repricing of liquidity, I think. I mean, I think like a lot of things in this space, the regulatory reform, the bigger picture of regulatory reform is exposed in some areas where in the past certain risks were underpriced when we're doing that through margins and capital requirements on OTC derivatives and so on. So it's happening everywhere, and so the question we're wrestling with here is, I mean, it looks to me like markets are fairly liquid, like bid-offer spreads are narrow and volumes are pretty decent and so on. But the real issue is, let's say, the Fed reverses course and things start to fall apart a little bit, and then we talk about the fragility of this liquidity. What happens then? That's where the concentration is an issue. And also, there was also this myth, I think, that banks were always standing ready to sort of catch the falling knife, so that when markets were going to hell in a handbasket, the banks would step in with their balance sheets and absorb and take big losses to sort of maintain liquidity, and that's not going to happen either. So we're quite keen on the idea of alternate platforms, which are not just in the OTC space, but in the bond space too, and trying to bring in asset managers and others into these all-to-all type platforms. So we're very keen on the initiatives that the CFTC has taken in the derivative space, and we're hoping it broadens to other aspects of fixed income markets.
So if we look at all these markets, is it a matter of we're not quantifying the right data points to know what the risk is, to understand the risk, or do we just need to wholesale increase the standards of entrance for members of clearinghouses, increase standards for risk management, whether it be collateral, initial margin amounts? Do we just need more risk management, or do we need better and more specific analytics on that risk management so we know where those risks lie?
Well, I would say that we definitely need, both, maybe some of both, but definitely the latter, in that the risk, we have to be really sure, and to the most degree we are sure. Our DCOs, the commission reviews, for instance, when the DCO decides to do a new product and the margin, the appropriate margin, we review that, right? So we do have, in terms of the DCO's risk management, in various forms. It's a pretty rigorous oversight. That being said, as the market changes and as more and more unusual, that's the wrong word, but more and more interesting or exotic products start to move to clearing, I do think that we need to definitely make sure that the risk management, that the risk analysis, how much margin actually is enough, we do need to press it down on that, because especially as we'll talk more, I think, later on about the uncleared margin space versus cleared margin, right? So the difference between those could create incentives. Say, for instance, and those rules are still in discussion, but if the uncleared margin space comes out, and generally speaking, the uncleared margin is considerably higher than cleared margin. That's probably true now, but after that rulemaking, that may or may not be exacerbated, and that could incentivize a move to clearing of products that maybe don't need to be cleared. And so, with that kind of market pressure, I'm not saying this is going to happen, just kind of, things that we're thinking about, et cetera. But if that happens, then we're going to have to really look at, okay, what is the risk assessment, bear down even further on how CCPs are looking at some of these products. Also looking at how they're using their excess cash, because there's a lot of cash, a lot of clearing means a lot of cash that CCPs have. But all of those things, that risk assessment needs to be more robust. I mean, I think we can always, throw more collateral or problems, constantly throw more money at it, and that may or may not be solving the problem. It's really the analysis that's going to tell us what is the appropriate amount of collateral to have, and therefore, that's where we should be focusing.
Sure. Now let's hear from Avdood from Quantifi Solutions. We talk more about the evolution of these liquidity providers and how these new entrants are stepping up to the market. Many of them are from the buy side or asset management community at large. But when we really look at this, what's the real implications for a more muscular buy side as far as their activity in the marketplace? Does this stress their technology framework, or is this more of a capital exercise? What are your opinions on that?
Yeah, so I mean, I can give you a perspective from what we are hearing from our clients and prospects that we talk to on the buy side. So essentially, what has happened is the regulations that came into play since the credit crisis. In general, there have been regulations over all market participants, but obviously these have been there have been more demanding regulations on the institutions that are deemed systemically important, and typically banks fall into these categories. In fact, there are very few buy-side institutions, and most of them are insurance companies, which have been tagged as SIFIs, systemically important financial institutions. Most of them are banks. So, and in general, the regulations have, as Petal mentioned, imposed higher capital charges on banks for doing certain types of businesses which are deemed risky. So as a result of this, banks are withdrawing from those businesses, and that has essentially opened up, has created a vacuum in the marketplace, and some of that is being filled up by buy-side institutions. In general, buy-side institutions, but on the more risk. I mean, whoever buy-side institutions have, which have a higher appetite for risk, like hedge funds, are especially active and trying to fill up this vacuum that has been created by banks withdrawing from certain areas. And then, since hedge funds are not regulated, and in general asset managers are not regulated to the extent that banks are, these areas are still profitable for them to play into. So we are seeing a lot of that now. From a system point of view, I think you would say that's a cause. Some say that's a cause for concern, because this is what you tag as is commonly referred to as shadow banking. So essentially, you have risk moving into areas of the financial marketplace that is not visible to regulators as clearly as when it is parked in banks. So that, from regulation point of view, that is a cause for concern. But unless, I think as long as the regulators keep an eye on making sure that these institutions don't threaten the system as a whole, essentially we don't have an LTCM in the making somewhere, I think that risk can be managed, and I think I'd like to hear from the others on that aspect. But from what this means for the buy-side firms is essentially before I get into that, I mean, there is another factor in play here is the low interest environment that we are in, which is essentially putting pressure on returns for the buy side. So there is this opportunity, and then there is this motivation to take more risk because of the low interest environment. These forces are acting together for buy-side firms, especially hedge funds, moving into areas that they have not traditionally played into, in which they don't have a real good understanding of the risk because they haven't traditionally played into this space. And to cope with that,
let's maybe pause right there, Abdul.
Yeah.
John or Patel, do you guys have a response to that as far as the increased need for regulatory oversight for these new players as they become more like the sell-side institutions in the liquidity space where they step up and fill that gap? Or do we need to look at them harder? Do we need to impose new regulation? Are we eventually going to minimize their opportunity to succeed in this platform because they're going to get similar regulatory charges and other kind of oversight? Do you guys have a response to that?
Well, I'll jump in on that. I mean, this is really a personal view, and maybe from a few others at the IMF. But regulations really should be redesigned so they're more activity-based and entity-based. That's how you get all these regulatory arbitrage situations. Because if you were banked, you're regulated as a bank. If you're insured, you're an insurer. But the regulation should be rejigged, I think, so that they're more activity-based. So it's what you do and not what you are. That would solve a lot of these problems.
I'd also add to that. I mean, that would be great. I don't see it happening in the near future, especially with kind of the territorial awards. But putting that aside, in terms of your question, Saul, I would say that it's not that we would have to necessarily look at these entities harder. I mean, there definitely is, like I mentioned before, a certain level of comfortability with the banks because of familiarity and because they are looked at by a number of regulators. And that way it's kind of a plus that there's so many eyes on them in different aspects of their, of their business, and that gives a certain level of comfort. And so when we have entities that are not banks, we're dealing with the reality that they are not similarly regulated. Now, when I think of the buy side, the different things come to mind, right? A hedge fund is different than more of a traditional asset manager, that has, a different clientele. It's one thing to have a high-risk focused type buy-side entity versus something that's much more moderate and traditional. And so, so some of these entities are familiar in a different way in terms of, we know them. They're not like brand new. They aren't banks, but, some are extremely well capitalized, and we have had enough dealings with them to be somewhat comfortable with that entity. So it's not as if we have to really bear down on all of these entities because they're brand new. That having been said, though, I think that smart regulation is when the regulator sits back and says, okay, what is the risk we are actually trying to address, and what's the what's the wisest way to do that, and therefore, okay, let's now define what an Fcm needs to be, in this space. We've kind of assumed, often that the Fcm is the bank, so we've almost equated in some ways, I wouldn't say entirely, but equated Fcm with bank. But let's actually bifurcate that, separate those two and say, okay, what exactly does an Fcm need to be? I find it interesting that the CME decided to lower its minimum requirements in the IRS space. That's an interesting industry move. Is that kind of a reconsideration? In this market, how much capital do you really need to be an effective, trustworthy FCM? So I think that's what we have to do. We have to step back, look at that FCM definition, and then just, look at who's out there and who's willing to take on that role. Now, clearing is different than execution. The buy side, from what I've seen, has been more active in the execution space, but I haven't seen a ton of people coming into the clearing space and acting as an FCM. We need to look at that. We need to look at what the incentives are and whether or not the wall that we've built to become an FTM, whether that wall is appropriately high or is it too high given the actual risk that we're concerned about. So I think we do need to look at these new entrants, but I think before we look at the entrants themselves, we need to take time to figure out, okay, what does, without looking at who's coming, what does it mean to be a reliable FCM that we can put a stamp on and say, we're confident with ongoing surveillance, we're confident that these entities will not bring down the system, because they are, well collateralized or whatever, or well managed or very transparent. We have to look at what those things are and then say, okay, who's interested in taking on this role, and then looking, using that as the lens versus just assuming that because you're not a bank, you're risky, you're dangerous, etc.
Excellent. So just switching gears just a little bit as we explore what's kind of driving or enabling these buy-side participants to kind of migrate their business models. We look at the change in market structure, and we look at all the new kind of participants with CEFs and CCPs and swap data repositories and other collateral functions. Abdud, if I pose the question to you, what effect is the increase in financial technology efficiency, the increase in automation and effectiveness of financial technology, how is that making it easier for the buy side to do these types of activities, participate in the new market structure and become more of a frontline player or a liquidity provider?
Yeah, so I mean, playing in this new market structure, right? I mean, it requires essentially to do these things. First of all, the buy side needs flexibility, so they need systems that can give them the ability to play in different asset classes. So cross-asset systems, which help them engage in multiple strategies. Then there is also, because of the increased transaction costs, you need something that will enable you to do a transaction cost analysis. Also on the risk side, these are the risk modeling. They need models which are at the same level of sophistication that were used by banks. And finally, transparency. I mean, the market is demanding all stakeholders, especially investors and regulators, are demanding more transparency. So better data management, better reporting tools are what are required. Now, so this is a good point in time for buy-side firms to rethink their technology, their processes and systems, because when your business models change, obviously processes and systems have to change. So on the technology front, there are advances like they could take advantage of distributed databases, like NoSQL databases, which provide a scalable and cost-effective alternative to expensive relational databases. Cloud platforms, there are a number of them available now, which offer easy cloud deployment. So that is another technological advance that could be taken advantage of. Modern multi-core vector-enabled CPUs are much more powerful. And low-cost memory is facilitating in-memory analytics that can analyze massive amounts of data sets in real time for them to be able to do, say, pre-trade analysis to choose the most efficient execution venue. And finally, mobile devices, support for mobile devices is another advance that buy-side firms can avail of while they rethink their technology strategy.
John, do you have anything to add to that point?
Not so much on the technology side, but perhaps on the question of what might be impeding buy-side participation on these platforms. And again, I think more broadly than just CEFs, but bond platforms and so on. I mean, there's the controversy about this whole name and give up thing that's causing some of the bigger buy-side firms to shy away from some of the what were dealer-to-dealer platforms where it was convention to give up the name of the counterparty after the trade, and the buy side prefers not to do that because they fear what they call information leakage. I mean, that's an issue why they might be averse to joining some of the bigger platforms, but like Bloomberg, for instance, I think is having a lot of success in the credit derivative space, and there's several other platforms that are doing very well in the bond space. But still, I think there's still going to be an aversion out there for some of the buy-side guys to jump onto these platforms. And before my life at the IMF, I was at the Bank of Canada trading swaps and bonds and so on. And I can see why I would have an aversion to doing all of my trades on a screen, because the trading I did was very relationship based and often multi-part. Not just multi-part in today's transaction, but sort of based on a strategy that I've worked out with a dealer in terms of shifting my portfolio over a course of a week or something like that. And that's where my preference there would be for a telephone type situation. Now, you could say that the RFQ, request for quotes, electronic platforms kind of do the same thing, but I suspect it's kind of awkward to do a multi-part trade where one of those parts is not trading on any of the platforms. So and you need simultaneity of your trades to make them work. So I think there might be a pretty big core part of the buy side who will remain averse to jumping onto these platforms.
Petal, do you have anything to add to that particular point?
Well, Commissioner Bowen has actually gone on record in saying that we need to end name give up. And just for, the reason that John just gave really typifies why this practice, really has its limitations, and definitely understand, how things have been done in the past and the importance of relationships, etc. But as the market shifts and as banks start to pull back, and we need new entrants to come into this market, what is the practice that made sense in the past doesn't seem to make sense in the present, since the people who want to be able to move in and out these markets don't necessarily want to be known and have that affect other trades they have that are not on the screen. And so, as a result, she's come out, several other commissions came out. Unfortunately, one of them just left, Commissioner Weetjen, but nonetheless, they've been public, including the chairman, public about the end to name give up, and we are still very supportive of that and think that it would really help to address some of the liquidity concerns, meaning, basically that, as banks pull back, others need to enter, not having that impediment there could really help that along.
And of course, there's absolutely no need for post-name give up in a centrally cleared world, which these steps are.
Which brings up a very interesting point. So just going forward a little bit. So next September we have the rollout, or the beginning for rollout of the non-cleared margin rules, which will affect mostly buy-side participants, as they have the option now to remain bilateral and still kind of follow a modern market structure regulatory trade flow, as far as exchanging initial margins, exchanging variation margins, and reporting and transparency. Is this going to, in your opinion, is this step a good step for the future? Is this in the right direction, or is this a bit of an overkill from a collateral or operational perspective?
Well, I would just say that I definitely think, if you're asking whether it's a good step to have, a rule on uncleared margin to actually make sure that that margin is appropriate, I think that is, because we definitely don't want to incentivize the market to not clear because it's so much cheaper to not clear because there's no real regulation there. In order to, going back to the G20, in order to properly protect or rather to properly manage the risk in the market, we definitely do need to have meaningful, appropriate rules in terms of the margin required for OTC products. And so I think that is important. I do think, as I mentioned before, it's always a question of the difference between that, right, between uncleared margin and then the margin that you have, when you're clearing. There's certainly good reasons to encourage clearing, but we don't want to unnecessarily penalize, penalize not going to CCPs, but rather having bilateral transactions, because some products still need to be traded that way. So, it's a question of the incentives produced, if one is much more difficult or much more burdensome than the other. And so, right now we are focused on that. In terms of uncleared margin, one of the issues is that there are multiple regulators, in this space, because it has such an impact. And so, it takes a while to come to agreement on what's appropriate, but that's certainly an area that the regulators are highly engaged in at the moment, and that also makes me reluctant to say too much about specifics because it's in deliberation stage more than some of the other things. And so, but once again, looking at really covering the risk, not just focusing on one aspect of the risk, for instance, clearing or execution, but also looking at that unclear space.
So when we look at these future rule sets and non-cleared margins in particular, John, does cross-border situations make the implementation of the non-cleared margin rules that much harder and more difficult to manage in the future? And then, how do we envision this global risk management when we do have these cross-border transactions that now require margining and the same kind of treatment that would happen under a CCP construct? How challenging is that going to be, and what are some possible solutions?
I'm not too plugged into the non-cleared part of the space, but the question is rather general and applies to cleared trades too, I think. I mean, we do know there's an issue with cross-border consistency of rules and so on. We know that there's the spat between the CFTC and the European, and we hope that gets resolved soon. But that's the high-profile one. But we at the IMF, we get our ears full of from other countries that we don't usually talk about. I mean, Hong Kong and Australia and Canada and other countries that also, they're eager to play their part in all of this too. And of course they're waiting for the U.S. and then Europe to get their positions in line before they move too aggressively ahead. But Japan is moving very quickly ahead with their rules too. But many come to us as countries where their banks are doing transactions with U.S. and European counterparties, and there may not be cross-border recognition of CCPs, and maybe their officials want them to clear. In some cases, their officials want them to clear in their country. It's a mess out there, and it's not just the high-profile one between the CFTC and Europe, but everywhere. I mean, we need to basically get everything in line for these markets to work smoothly, because I think there's a lot of forgotten players out there that are not in the U.S. and Europe. But there's the Financial Stability Board. I keep bringing that up, but that's kind of the group that sort of tries to bring all this together. Has working groups and committees that are working on identifying where these frictions are and how we can resolve them. So I'm hopeful that we're not going to meet that 2012. Well, we haven't met that 2012 deadline that was set by the G20 back in, I think, 2009. But we're getting there, and it's just a rockier road than we expected.
Yeah, that's a very interesting point. A lot of my clients face these issues, whether it's in Asia, South America, Canada, Europe. Trading cross-border goes well beyond just a product or a CCP issue. It's a political issue. It's a domestic issue. It's ripe with challenges, and as Petal mentioned earlier, with regulatory arbitrage, these countries and the participants in the countries do not want to avoid or not follow regulation, but there are methods that they can use that are fully legal and acceptable in their domestic capital markets that does avoid some of these procedures like clearing, trade reporting, exchanging collateral. So it is quite messy, and another excellent point, there are many other nations besides the U.S. and EU region that are involved in these global capital markets, and those local jurisdictions have to make those decisions on how they want to participate as well. So when we start talking about cross-border issues, and now we start talking about non-cleared margins, really, are we looking at a case for a diminishing bilateral marketplace and OTC marketplace and an increase in the exchange traded products? Are we going to see an increased use of equivalent futures to mimic exposure in the credit and rate markets? We've seen a lot of entrants in there in the recent times, but certainly volume has not migrated. At most, the global volume has only migrated 1 to 2% to these future equivalents, whether they be credit or interest rates. John, Petal, do we feel like there's any future here with swap equivalent futures? Do we think that there will be more migration because of the exchange traded status that these futures have, and the more straightforward regulatory issues that are involved with trading those?
Perhaps I'll lead off. I'll go back to my old job and say that the futures model will not work for all counterparties. When I was at the Bank of Canada, the basis risk was a serious issue. We needed to minimize that. So we were doing mega-sized swaps that were swapped against a bond issue that didn't have a CME date in on its coupon payments, and we all know that BlackRock is calling for more standardization of corporate bond markets, and the corporate bond markets the issuers are not the same reason I wasn't keen on standardized issuance. They aren't either. So they've got their own risk management issues to deal with that are very real. Cash flow and timing and covenants and so on that just don't match with a future style contract. So I'm a little bit. I think there may be room for growth, but I think there's going to always be a big role to play for bespoke contracts.
I agree with that.
So when we look at these issues and how they affect the buy side, let's turn it back over to Abdud. With all these changes of choices and new issues that are coming on the forefront with regulation and adherence to new future regulation, what are the buy-side firms doing to cope with what's going to happen in the future? Non-cleared margins, more exchanges, more reporting requirements. What are you seeing, Abdud?
Yeah, so what is essentially happening is there are two factors that we're seeing that are playing out. One is the regulations, which is essentially making sell-side firms withdraw from some businesses. So buy-side has you can look at that as an opportunity there. But regulations, especially to do with clearing and even margining of non-clear trades, is increasing transaction costs. So essentially affecting profitability. So that is something that needs to be managed well. So we are seeing that happening. And then there are other demands like to play in this environment, you need the flexibility to support different asset classes. You need more sophisticated risk management tools, because as you're dealing with different asset classes in areas that traditionally the buy-side firm hasn't played in, You need an integrated view of risk, so heavy investment in your risk management infrastructure. So do you have a integrated view of risk across your portfolio? You're able to stress macro as well as micro factors to see what is the impact on your portfolio of different scenarios, and as well as transparency. So for reporting to investors and regulators who are demanding more and more transparency, you need better data management and BI tools. And all of this delivered on an integrated institutional quality infrastructure. And so that is important. So you need your straight through processing, your workflow management, all the systems have to be in place in a sort of an integrated solution. The last point is on technology. So all this leveraging the latest and greatest that technology has to offer.
Are these improvements going to work directly with the clearinghouses to calculate and to receive information on initial margin, variation margin, and other kind of issues in the clearinghouse, like default fund contributions?
I think John might be a better person to talk about the default fund contribution. But from a buy side's perspective, I think what we think is important and what we are working towards as far as the doing a transaction cost analysis is to give them the ability to choose the most optimum execution platform, be it bilateral or through a clearinghouse. So we have come up with a framework that lets buy-side firms analyze and figure out the optimum execution venue based on the incremental transaction costs that they would face when they do a new trade, basically. So the ability give them a platform to pick the optimum venue when they're executing new trades.
John, do you have more to add to that as far as the importance of this collateral and what it does in the clearinghouse as far as how we communicate it, how we view it, and how it's used from a risk management perspective?
Not too much. I mean, that's not really an area that I've been focusing on, but actually what I've been focusing more on is sort of the bigger picture, which is how do we cover when a clearing member defaults? How do we keep the CCP in operation if it's a really serious default of one or more large clearing members? How do we keep the clearinghouse in operation after it's run through all of its sort of pre-funded resources? And you know, most of you are probably familiar with the so-called default waterfall, where first of all, when a clearing member defaults, you basically hit them for all their margin default fund contribution, and then after that, typically you hit up the CCP's preset capital contribution, which is a very controversial area. We won't get into that today, but lots of opinions on what that should be, how big it should be. And then you hit up the default fund contributions of all the surviving clearing members, and then there might be even additional assessments. Now, if it's a really big default, and let's say it's to the largest clearing members, so we've blown through all of that, the next phase is after that are the ones basically where the red lights are flashing. The last part of that waterfall is resolution. That's where basically authorities have to step in and keep it running. And you know, we have created too big to fail institution here, or we call it too important to fail institution. So I think it's almost inevitable that we reach that point with one of the large CCPs. The government or authorities are stepping in. So there's that little layer above it called recovery, and that's a very controversial area right now. And there's all kinds of different options being looked at for recovery. So in this case, you've run through all of the members pre-funded resources and also the CCP's own capital and so on. So it's basically bankrupt. Now what happens next? Now, this slide you're looking at right now, I'm not going to go through it in detail, but these are the various options that are being looked at quite seriously. And in fact, some of them are in place. And one of the most popular ones to talk about is what they call variation margin haircutting, or VMGH. And what you do there is you reduce the payments to the in-the-money participants, and then you collect fully from out of the money the variation margin. And the beauty of variation margin is that it does cover 100% of the losses, so you don't actually even have to reach that last phase. The government is not on the hook for recovery. And it burdens participants who may be best able to absorb haircuts. And I bolded may there because you really don't know, actually, because you maybe the positions of that participant are hedging something else. So actually, it's a flat position, and so there's an element of unfairness, I think, to the VMGH idea. Now, none of these other options are perfect either, but just focusing on VMGH, there's a potential element of unfairness. So we don't view positive variation margin as a good indicator of that counterparty's ability to absorb that loss. And if you go to the next slide, you can see that in fact, when we say clearing members or clearing participants, this is ISDA's view. They've done quite a bit of work on looking at all these different options, but we're not just talking about clearing members here. We're talking about clearing participants. So that's the buy side too. They advocate passing through those VM haircuts to the customers. And in most cases, actually, the dealers are going to be running flat positions because that's the nature of their business. So actually, if you isolate just the dealer business, there's probably not much implication of VMGH on them, whereas the buy side is generally running one-sided positions. So they're more likely to actually be in a position to be hit by the variation margin. So what I don't know is what the contracts that you buy-siders out there have with your FCMs in terms of what that flow-through of that VMGH would be. And right now, LCH ClearNet is the only major CCP that I know that uses VMGH in that recovery phase. So any of you have interest rate swaps or currency swaps that are cleared through LCH ClearNet, you're part of the VMGH gang. But what I don't know is the extent to which your FCM can actually flow through that VMGH to you. Just something to keep in mind.
Hi, this is Petal. Unfortunately, I have to leave, and I just wanted to thank you for the discussion. It's been just really helpful so far.
Petal, thank you so much for joining. I know that we went a little bit over, and we're going to wrap up right now. I'm sorry that you can't stay for the conclusion, but we're just going to cover one more point and then take some audience questions. So thank you so much. Again, your contribution was excellent. Yeah, so with that said, we're gonna we went a little bit over and we're coming to an end. I would just like to open up to the audience their ability to punch in a question in your dashboard. So go ahead, if you have any questions that you'd like us to address, go ahead and punch those in now. We've received a few. I'm going to pose one more question to John and Abdul, and then we're going to review some questions and then sign off for the day. So when we look about what's next and what's in the future and putting on our futurist glasses, we look at the various regulatory regimes in their timelines. What they state for a few years from now and then maybe a little bit after that is what we call market optimization. So this includes margin optimization, collateral optimization, trading and reporting optimization, the ability to transact cross-border, and the ability to track it all. Really our best laid plans, what we envisioned in our minds when we created these rules, and really carrying it out to the nth degree so that all these data points can be recovered. We can have a lot of efficiency in the markets. We can trade, know our cost of transactions, but also trade in the most efficient manner. So, to John and Abdud, how are we going to get there, and what other elements of this vision are really important to you?
Maybe I'll jump in first of all. I don't have an awful lot to say about this except to say, I'm fairly heavily involved in the Financial Stability Board, OTC derivative working group, and other initiatives around that. And I mean, when 2009, when the G20 said this was going to be wrapped up at the end of 2012, they never dreamed of all the complexities that we're going to be faced with, not just the cross-border things and so on, but just just look at the amount of rulemaking initiatives that the CFTC and others have been through. It seems like dozens and dozens of different little bits and pieces that were unforeseen. And so I think we've missed the deadline, but I think we're moving in the right direction, and we'll get there. Probably we're still many years away from the end point, but I think I'm hopeful that we will get to that world where cross-border transactions will be done reasonably seamlessly, and the technology will be honed to the point where many of this can be done on screen and so on. So I'm pretty hopeful.
Yeah, I mean, in my opinion, this is still playing out, right? I mean, it's going to take a few years for this to play out. So at a holistic level, all stakeholders in this space, regulators, investors, market participants, as well as solution vendors like us, are actively grappling with the points that we have all raised so far in the discussion. I envisage things to settle down over a period of time, and what emerges is an altered landscape. I mean, this has the potential to completely alter the landscape and the different roles that market participants have traditionally played. So that will all settle down, but on an individual market participant level, obviously, you can't afford to wait for it to stabilize. You need to make decisions right now, assess your options, make decisions which space you are going to play in, assess what kind of processes and systems you need to play in that space, while retaining the flexibility to adapt as new changes emerge.
All right, guys. Thank you for that. We have many questions that have come in. We only have time to address a few of them. I've been able to list a few right here. So let's address these, and any other future question you can send to Quantifi. There's a contact information on the webinar invite, and we can follow up the conversation then. So I'll pose this to our audience, or to our panelists rather, Abdud and John. This is a great question from the audience. Will recent market volatility cause a delay in the rollout of other future regulation, in your opinion?
Well, as kind of an insider in these processes, I would say no. I think there may be the market volatility, and it maybe might influence the path a little bit, but I think that the authorities are pretty dead set that the regulatory reform that's been put in place is the right way to go. They recognize that there's some trade-offs, and as I said before, some of these reforms expose underpricing of certain risks and so on in the past. Right now we're doing some work on market liquidity, so we've got all these people pleading with us to make the case that roll back some of these regulations because they're affecting the ability of banks to be liquidity providers. But I don't think there's any appetite for that at all, because I think after what we've been through in the last decade or so, there's no stomach to risk repeating that. So I really don't think that there'll be any delays coming out of the volatility. That's just a conjunctural issue. We'll make it through it using other means, but not by tapping the brakes on regulatory reform.
Yeah, I agree with that position.
That's great. You heard it here. We're going to drive forward. regardless of market volatility and other kind of issues that are going on in the geopolitical landscape. Yeah, that's a great thing to hear, and hopefully we'll continue to drive ahead. With that, more tangentially related, Abdu, do you feel that IT spending will continue to be a priority in the near future? And then, John just mentioned that we're going to continue to forge ahead with these regulations. So will the continue strong investment in financial technology be a theme that we'll see for the continued future as we adjust to more regulation?
Yeah, absolutely. As I said, I mean, these are some of the businesses that the buy-side firms, I mean, since this is focused on buy-side, let me focus more on the buy-side. These businesses, the buy-side firms haven't traditionally engaged in, and then some of them require a different level of investment in IT systems, different methodologies, different models, different infrastructure. So there's no doubt about it that it's going to go up, and then this hasn't fully played out. So there are more regulations. The regulations haven't been fully implemented yet. So things like non-cleared margins will require more investment. I don't think a lot of the firms on the buy side are ready to use the model method for non-cleared margin rules, for example, and the standardized methods, the margin calculated using standardized methods might be quite high and may not give them the adequate netting benefits. So there is going to be continued investment in IT systems.
I would just add that, yeah, as someone who was actually involved in these markets, like I said before, and this is going back into the early 90s and so on, you know, we were like many others and running our portfolios off of Excel spreadsheets and so on, and a lot of manual entry and manual transfer data from one system to another, you know, and then we evolved into a straight-through processing thing. I mean, that's essential, I think, for everybody to be eventually plugged into a straight-through processing type system, not only for the, you know, to get the transaction done, but now we have the trade reporting requirements and so on. Then that's becoming more and more complex and very rule-driven with all these new acronyms and so on, and the standardization of data points. So, you know, I think the days of you know, running a portfolio off of a spreadsheet are long gone.
You'll be surprised at how many still do that.
Yeah.
So.
Excellent. So our final question for today, looking to the future from a buy-side perspective, will cleared volumes continue to increase, you know, month over month or year over year with the evolution of the non-clear margin rules? So the question here really is, will the capital charges of non-cleared margins drive more participants to clearing or drive more participants away from clearing?
I think the cleared volumes, I think, will continue to improve, continue to increase, not at the same level maybe, because I think by far the biggest market here is interest rate swaps. Standardized interest rate swaps are getting cleared to a large extent. So I don't think the rate of increase is going to slow down, but I think it's going to continue. If you notice recently, there have been suggested changes in like single name CDS roll periods to make them more standard, more aligned with CDX. I think that will help more single names CDSs getting cleared. So as more products get standardized, I think clearing will increase. I mean, on the non-cleared side, again, I would say non-cleared is not going to go away. It will still be around for non-standard products. But again, it's not that easy for smaller players to calculate these margins and abide by the rules. As I mentioned, I mean, a lot of them don't have the models to use the model method for non-cleared margin that has been recommended. Most of them will resort to the standard method, which by definition does not give them all the benefits of netting and offsetting positions. So in theory, they will end up playing more margins if they do that.
Not to mention that, you know, amongst those interest rate derivative products, I mean, there seems to be a large chunk of them that may be unclearable for risk reasons that CCPs will not want to touch them, right? I mean, I've been involved in the OTC space website, and I've upgraded their lexicon basically. And one thing I had was I actually grabbed it from Citigroup. It was from a long time ago. It was a listing of all the different types of interest rate derivative products, and it's mind-boggling the number of different types there are with really exotic names and so on, and they would be brutal to try to model. So and there wouldn't be enough of any one of those to sort of I think make a CCP want to sort of set up a module to clear those. So I think there'll always be in that interest rate swap space a fairly decent chunk of stuff that will never be clearable. If someone has to clear it, right? Someone has to step up to the plate and say, "Yeah, I'll put my neck on the line."
Yeah.
No, that's a great point. That's a good point to close on. Again, I apologize that we went a little long here. We actually could have gone much longer. We have a lot to share with you guys. We covered a lot of different categories and topics and went into some pretty good depths on a lot of the really key issues here. Thank you to all the participants and attendees. Thank you for your excellent input, and we're going to continue to deliver these to you in the future, so look for future announcements for other webinars. Again, any follow-up questions you have, please address them to Quantifi with the contact information that you received on your invite. And with that, I say thank you to everybody. Have a wonderful week, and best of luck in the future. Thank you so much.
Thanks all.
Thanks all. Thanks
everybody. Thank you, audience, and we'll see you guys soon.